So to that point, Bobby, do you want to then, what was interesting in your article is you said you found the Holy Grail. You actually had a very old policy. So maybe, can you first explain why is it tricky to go look, like if you want to say, how did this bond fund perform? That's pretty easy. Or how did the S&P 500 perform over the last 30 years?
Yeah.
But if you want, and I've encountered this myself, to go do research to say, what's been the average rate of return on whole life policies over the last 30 years, you can't just go Google that.
No, you can't. You can't. It's actually kind of weird that you can't Google that, but it makes sense the more you understand. So, there's a difference between gross returns and net returns. You can kind of figure out the gross return by looking at historical dividend interest rates. So again, just basic term of that. We've been talking so far about what I would call non-par whole life, where we have a guaranteed interest rate assumption, guaranteed mortality assumption, guaranteed expense assumption that creates a guaranteed premium, guaranteed cash value to support a guaranteed death benefit. So there's no moving parts. In the real world, of course, and especially when you think about an infinite banking concept, we're not talking about non-par whole life. We're talking about participating whole life. And so the kind of corollary to non-par in the par world is a product where everything is still guaranteed in the base contract, but obviously the expenses are higher than the carrier actually incurs. The interest is lower than the carrier actually earns, and the mortality is more punitive than what the carrier's actual experience is, because the carrier's underwriting these policies. They're underwriting you at preferred or preferred best. The 2017 CSO assumes no underwriting for the mortality table. And so the premiums in the whole life policy are higher than if you just based everything off of kind of current assumptions about expenses, mortality, and interest. And so to your point, in a UL contract, the carrier just sets non-guaranteed rates, but they have the right to change the rates later. Well, in a whole life contract, all the premiums are based and the cash values are based off of the guarantees. But if interest is higher than the guarantees, or expenses are better than the guarantees, or mortality is better than the guarantees, well, there's profit. And I think one of the most powerful concepts in whole life is just that there's, if whole life is expensive, then that must mean that it's profitable. I heard this line from a Northwestern rep this week that I thought was just so good. If whole life is expensive, then that must mean it's profitable. Most people go, yeah, I guess that's true. And then the follow-up question is, okay, well, who gets the profit? Well, the people who own the insurance company. Okay, well, who owns the insurance company? Well, if it's a mutual insurance company, which is basically only mutual companies sell whole life. So if it's a mutual insurance company, then who gets the profit from these expensive premiums? The people who own the insurance company. Who's that? The policyholders. Oh, well, how do the policyholders get their share of the profits? Well, that's called a dividend. And so you get this dividend that can be paid to you in cash, but most people put it back in their contract to buy additional insurance and grow cash value in their policy. And so that the interest component of that dividend is called the dividend interest rate. And carriers have histories of their dividend interest rates, in some cases going back more than 100 years. And so when you go back to this concept of a gross rate and a net rate, you can go back and see the gross rate. And assuming that mortality isn't at the guarantees, and assuming that expenses are under wraps, that gross rate is actually a pretty good sort of proxy for, okay, assuming expenses are reasonable and mortality is reasonable as any other insurance contract, what's the sort of rate of return you're earning on a gross basis? You can look at the DIR. And I think that's a better proof point than most people give it credit for. Like, we've got 100-year history of what the actual interest component has been on whole life contracts. It follows certain patterns. There's explanations for why they do what they do. Historically, they've been really strong. Like, this thing works at the gross rate. And again, I think that kind of goes underappreciated. Now, the hard part is, to your point, why you can't Google, okay, what's a normal policy performance for a whole life contract, is because the gross rate is up here, but the net rate is policyholder specific. So a 35-year-old's net cash value IRR is going to look very different than a 75-year-old's net cash value IRR when they buy the new contract, because obviously the 75-year-old's older, the mortality charges are higher, the premiums are higher, the expenses also may be higher because of more underwriting, more commissions, whatever. And so the returns on the cash value are going to look totally different for those two policyholders. What if the 35-year-old buys a pay to 100 contract, which is more protection oriented, so less cash value, more death benefit, or buys a 10 pay, right, more cash value, less death benefit for dollar premium? Okay, well, the IRRs on cash value look very, very different. And so that's where, when you talk about sort of Googling average whole life performance, the problem is that every policyholder effectively has a unique policy performance in terms of the net rate, even if everybody has the same gross rate, because every policyholder is a different age, rate, premium size, policy selection. You get in, it's way too granular. And so I think in terms of comparisons, the gross rate is the right point of comparison. But the net rate is what clients actually experience.
Let me stop just to make, so yeah, I'm tracking with it, but just in case people are quite familiar with the terminology here, so because this is critical, I'm glad you naturally went in this because I was going to bring this up to make sure you covered this distinction. So right, if people are trying to look at and say, oh, well, what's the average rate of return on T-bills or 10-year treasuries, blah, 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 S&P 500, real estate, and then so what about life insurance as an asset class? Yeah, they can, as you say, easily go look up and see what has been the average dividend rate on whole life insurance, or they can get more specific about what class of companies they're looking at or what have you, and then they can look at what's the rating of these companies in terms of their risk of default and that kind of stuff. But the more they poke, that dividend rate looks pretty good, but then the critic or the cynic will tell them, whoa, just because Northwestern or Mass Mutual says their dividend rate over this period was on average X, that doesn't mean if you get out a whole life policy with them and you're paying premiums, and then it's some give like 11 years into it, you ask, okay, given the out-of-pocket cash influx that the client had to pay, and now looking at the cash surrender value as of year 11, what is the average annualized internal rate of growth on that? That's not the same thing as what was the dividend rate on average over that period. So that's the distinction we're drawing. And
correct.
So, okay. So can you maybe, can you maybe just once again explain why it's not like they're lying to you, but why it totally makes sense that you can't just go from the dividend rate to what the internal rate of return on the cash value is?
Let me give you just a simple analogy everybody's familiar with. So if I look at mutual fund performance without taking fees into account, and I just look at the top line performance and I don't look at fees, that's a real number, right? That is a real performance of the asset. That is the gross performance of the asset. That is a comparable number across fees. But once you take fees into account, then you end up with a different performance for funds. So there may be funds that perform really well but have really high fees. Or let me give you even a better example. Funds have different tax drag. So if a fund has a lot of turnover or a lot of distributions and you're in a high tax bracket, that fund is going to deliver you a net after-tax return that is much lower than what the headline return is, even after you take the fees into account. So when you think about any investment you make, and then by the way, if you have an advisor and the advisor is wrapping the assets and charging you a planning fee, well, you have to take those line items kind of into account when you think about your actual net return that you receive. So there's a top line fund performance return, and then you've got fees, and then you've got tax drag, and then you got advisory. So everyone's very clear with that on the investment side. Very similar thing going on here in life insurance, where there's a gross rate up top. That's the dividend interest rate. And then you have a mortality deduction, which, just pause there on this because this is really, really important too. Mortality is not a cost. This is something people get really confused about because they say, well, what's the IRR on my cash value? Well, part of the reason why your IRR, if your dividend interest rate is 5 and your cash value IRR is 3.5, probably 75 basis points of that 150 basis point difference is due to mortality protection. That is a benefit. The death benefit is a benefit. The cost of insurance is the way you pay for the benefit. So on an actuarial basis, that's net neutral, right? You're paying for a future benefit and you don't know if you're the first person to die or the last person to die. And so that's the fair market value of the death benefit protection you get. That's not a cost. That is a pre-funding of a future benefit that you will receive if you keep this policy for long enough. So, but it is a cost in terms of the IRR. We calculate the IRR. It's a benefit, it's pre-funding a benefit, but it does drag down the IRR. And then you obviously have policy expenses, which are commissions, carrier overhead, state premium taxes, whatever else gets baked in there. And so when you kind of roll that down, that's why there's a difference between the top line rate, the DIR, and what you actually get in terms of cash value IRR. And to my point earlier, because the mortality charges are different by age, a 35-year-old's policy is going to look very different than a 75-year-old's policy. There can also be difference in overhead allocations the carrier makes, commissions, whatever else, payment patterns that are going to create different IRRs. It's not really that dissimilar from what we see in the investment world. After you take into account fees, taxes, and advisor fees, we have the same sort of dynamic going on in life insurance, just we don't have any taxes. Instead of taxes, we have mortality costs. And the mortality costs fuel a future tax-free benefit. So that's where I think people get really caught up because they say, I want to Google the performance. Well, okay, what we need to find is the perfect policyholder that's held a policy for 25 or 30 years and basically validate that the policy did what it was supposed to do to essentially prove that the expenses were what they were supposed to be, the mortality was what it's supposed to be, which means really the thing that matters is that top line gross dividend interest rate. And you can kind of base your decision off of that. And that's, again, to your point in the article, that's what I found. And that was why that article cleaned up very nicely.
Yeah.
Because one of the other things that Dave Ramsey said, and this is really what leads into this, is what Dave says, and this blew me away. This is yet another one of these things that just is like not factual. And even if it was factual, you can't get the data. He says, on average, whole life policies perform at 2%. I think was the number he threw out, 1.5 or 2%.
Yeah, I think I've seen him say 1.5. Yeah.
Yeah. I think I know what he's talking about. What he's talking about is non-participating whole life. Well, you and I are not talking about non-participating whole life. We're talking about participating whole life. So I think Dave's got his stats a little bit messed up, but let's give him some benefit of the doubt there. But another way to interpret it is he has no idea what he's talking about. And so how do you kind of prove when you can't Google it that these things do what they're supposed to do? That, for example, the carrier isn't sucking up that big gross rate and really high policy charges, and carrier clients are actually getting good rates of return on cash value, even after taking expenses and mortality into account. That's what you got to prove. And so his point is, a carrier gives you the big top line rate, and then they just destroy it with expenses. Well, yeah, let's look at a real policy and see if that's actually the case. Because on the illustrations today, that's not what happens. So is it a bait and switch where the carrier is doing that and then increasing everything after the fact? You got to find an old policy that's in perfect shape to prove that it's not. And again, that's what I found from the article.
Yeah, before we get into that specific thing, which will be the last half of this discussion, but yeah, just to make sure people are getting the distinction, that the point you made, that how, like if your example, I realize I'm backtracking here, I'm trying to make my point for the listener. When you talk about different funds and they could have different fees, I could see people thinking, so those fees, like, to me mean nothing. It's just that they're overhead. And if one fund, is more lean and mean, and the other one, they've got, their executives live in posh or work in posh offices on Wall Street or whatever, that I don't care about that. That doesn't help me as my bond fund. But to the extent that when we say there's the dividend interest rate, and then that's higher than what the take home, internal rate of return of the cash value is, that one of those components of that gap is the mortality expense. And you were saying, well, that's not just nothing, like you're pre-funding something. And so the way that comes up is, in my circles, is people will sometimes like just casually say, infinite banking makes sense if you're healthy, but if you're not in great health, then the pure cost of the insurance doesn't make. And so I can just go through and show them using, just like you say, the 2017 mortality tables, and say, let's assume unrealistically there's no overhead and they're charging you just a pure actuarially fair premium. And I'll just work backwards and just, and I'll have like some guy that's got a 10% chance of dying every year, and one guy's got a 1%, and I'll, making up numbers. And I'll just show that the internal rate on the cash value for the sicker guy is lower. And so I'm like, see, but of course he's much more likely to die and get the death benefit. And so
exactly,
if you do it all, it's like in expectation, it's the same rate of return, all things considered, identically, because that's by construction, how I did the example to rule away all transaction costs and stuff and the slippage. So that doesn't mean in the real world, every carrier is perfectly efficient, obviously, but I'm just showing them that no, your intuition is wrong, that a 90-year-old who takes out a policy, if you take into account the death benefit and the expected return from that, it's a wash, at least, at a first pass. So anyway,
No, I completely agree. And what I'd say to that too is no illustration shows when you're going to die. No illustration says you're buying this at 72 and we're going to show you a death benefit payout at 85 because you're going to die on May 5th, 2035. Like that, no illustration shows that. And so every illustration has to show mortality going all the way out. But to your point, on an actuarial basis, you are going to die earlier if you're 70 versus 35. And you're going to pay higher COIs because of that. And that's okay because of the benefit of fits the COIs. And so I think that's the dynamic that's so powerful.